Hi, this is Mark from Right Line Trading. If you can hear me, if you could put a Y or a yes in the chat, I'd really appreciate it. All right, great. We're going to be starting. It's 3:57. We have 3 more minutes. I'm going to give time for additional traders who are just starting to file into the room now. So we're going to be starting promptly at 4 o'clock. Hey, good afternoon, everybody. Hope you had a great afternoon trading. We had a terrific day today. A strong up market, and we really profited from it. Great rebound today. Okay, well, we're going to begin. And what we're going to be talking about today is our code breaker credit spread system, where we sell an option spread and collect a credit into our account. In this kind of market environment, it is a supremely advantageous way of trading options. I just want to start with this this disclaimer that all signals and trading opportunities that we provide are for educational demonstration purposes only. Everyone should understand that participating in the markets does involve risk, and you should never trade more than you can afford to lose. Now, just a little bit about myself. I graduated from an Ivy League university. I went to the University of Pennsylvania for 8 years, and I graduated with a degree in applied mathematics. After graduation, I was inducted into the Phi Beta Kappa Honor Society for graduating in the top 2% of my class. I graduated summa cum laude with honors, and it was always my goal to go into teaching and research. And I applied to a number of universities and wound up staying in Philadelphia as a full-time professor at Thomas Jefferson University. While there, I published 15 peer-reviewed articles in top-tier journals. As I mentioned, I was a full-time professor. I taught an enormous number of undergraduate and graduate students. I've always considered myself to have the mindset of a scientist and a teacher and an academician. I mean, I've been an invited speaker internationally in many countries. I've spoken domestically in many cities, and I estimate I've mentored close to 30,000 traders over the course of the last 12 years. Now, if you see something like this, where trading options is easy, it takes 15 minutes a week, there's a new breakthrough code. I just saw one come in today. It's an 8-digit code. Somebody just broke it, and now you're going to make $1 million. There's a new hack. I would strongly advise that you skip over it really quickly. I mean, the options market is unhackable, and there's no cheat code that's going to make you a winner. It takes a lot of work and a lot of due diligence, and that's what I'm going to be presenting to you here. Now, a failed fad is unusual options activity. I mean, a year and a half ago, everybody was selling it. And I usually don't mention names, but the Najarian brothers had a service. I just can't remember the name of it. They're on CNBC all the time, and all they do is trade UOA, and that service just rolled over and died. Unusual options activity is a nice metric to look at, but it's just one of a number of metrics. It is no more powerful than any other. I've seen many major unusual options activity signals fail. A lot of these times, these are speculators that have a lot of money, and they're going to really lead you astray. So it's one metric of many metrics that we look at when we're going to enter a trade. It is no holy grail of trading, and that's the way it was marketed a year and a half ago. It's come and it's gone. Now, you have to treat options trading a lot like trading stocks. I believe that you need to have a managed portfolio. We're going to have 4 to 5 open positions at any given time. We're only going to trade liquid positions, and we're going to consistently utilize the same strategy. It's going to be formulaic. You're going to know it like the back of your hand. It's really my goal to walk you into the best trading opportunities that there are. But I'm going to use the same formula that I'm going to teach to you right now. Now, in the market, there are really 5 directions. I know you've been taught that there are only 2, up or down, but there really are, if we're looking at credit spread trading, there are really 5. Now, we can anticipate that a stock is simply going to move sideways in consolidation. If it's simply going to move sideways in a consolidative manner, that's great for us if we sold a bullish or a bearish credit spread. Now, we're going to look for trades that the stock has an upward trajectory, but not a strong upward trajectory. And you're going to see that after we enter it and we take a bullish position, it really only has to move up literally a nickel for us to bank 100% of our net credit. The same thing with the bearish credit spread. The stock only has to fall literally 10 cents for us to bank 100% of the credit that was provided to us at the time that we sold the spread. Now, if we believe that the stock is going to make a strong bullish move up, it's more advantageous to buy a call. If it's going to make a strong bearish move down, it's more advantageous to buy a put. But in this market where it's so choppy and so volatile, the market's like today, strong up day yesterday, and tomorrow market could roll over strongly to the downside. by taking sort of a semi-neutral stance on the stock, only anticipating a weekly bullish, weekly bearish, or a flat move on the stock, we have an enormous advantage to traders that are anticipating a big move up or a big move down. Now, what we are going to look to do is to leverage volatility. Now, some people call these time spreads and some people call these volatility-based trades. It really doesn't matter. The point is we need volatility to inflate the price. Let me mute my phone. It always rings. I always get 1,000 spam calls a day. And let me just mute it here. And so what we're going to be looking for are stocks that are exceedingly expensive so that we can sell them to somebody else and let them eat the high price that it costs to purchase them. Now, we're in anticipation that as the trade evolves, volatility is going to leak out of the trade. And remember that we have theta on our side, which is time decay. So as time eats away at the intrinsic cost or value of the option spread, and as volatility leaks out, the value of the spread we sold starts to deflate because our ultimate goal is to buy this spread back for either nothing, because it's simply both ends of our spread have expired out of the money, and we can keep 100% of our credit, or if we can keep 80% or 85%, we're really, really trading well. So we want to leverage time, which is on our side, and volatility, which is really high. I'm only going to give you trades that have a high, it's called IV ranking, which is implied volatility ranking. And volatility almost always leaks out of the spread as time passes. Now, the credit spreads, like I said, are very, very formulaic. And you'll notice, I mean, really didn't give you any sort of 20 minutes of lead-in to the meat and potatoes in this presentation. I'm not going to do a big song and dance. I'm going to show you our performance, but I really just want to get into the meat and potatoes of it and show you exactly what we do. Now, we're going to take a spread optimally that has 45 days to expiration. Now, there are some times when that 45 days is just impossible. Now, we want to trade a monthly expiration date. So right now, we're sort of caught because our next monthly expiration date, I believe, is November 17th. So I called a couple of trades over the weekend. One did not trigger because it was a bullish spread, and it just shot up in price, dropping our net credit, and we missed the entry. So I pulled the trigger on another one with only 30 days to expiration. Optimally, though, we want to look for 45 days. So every 6 weeks, we're going to turn over every single trade we enter. This is not a buy and hold service. Now, we're always going to do the same thing over and over again. Now, if we're going to take a bullish position, we're going to sell the 50 delta put, and we're going to buy the 25 delta put. If we're going to take a bearish position, we're going to sell the 50 delta call, and we're going to buy the 50 delta call. Now, we want a net credit that's 33% of the distance between the strikes. But lately, I've been looking for 45%. And I'll show you exactly how that works out. So I'm not going to go into the probability of profit here or the risk to reward on that metric, because I'm going to show you the metric that we've been really working with. Now, I'm going to just drop this for a second. And what I want to do, I want to go to this slide. And let me open it with Paint. So I can draw on it. Now, here's the width of the spread, or the distance between them on a bullish position on the put we sell and the put we buy. So let's take, optimally, I like to take spreads with a very narrow width. So we're going to look for a $1 width on the trade. So we're going to sell, say, a $40 put, and we're going to buy a $39 put. If they work out to the 50 delta and the 25 delta. And I'll show you, I'm going to show you some of the trades that I took. Now, what we're going to be looking for is where we get, wrong arrow, is where we get a net credit equal to 45 cents. Which means that our risk on the trade is 0.55 cents. Now, that's a tremendously advantageous risk to reward on a credit spread. To potentially make 45 bucks and risk $55 when we are using all the metrics that we can to determine the potential future direction of that underlying stock really provides us with a tremendous advantage. Now, at options expiration or close to it, if price is anywhere in here, we're going to get, if it's above the green line, and let's say that, you know, just for, we sold the $10. Oops, we sold the $10 put. And we bought the $9 put. And so this is a bullish position. So we have a $1 width. Now, if the trade closes between the trade, if the trade closes, but when we buy it, the stock will be right around $10. So if it closes at $10.01, we get to keep the full $45. If it closes at $9.55, we're break even. If it closes below $9.55, we're going to be in this zone. And that's where we're going to wind up with a loser. So, although the risk to reward is not, it's never going to be one-to-one because you can't get that much implied volatility on a position. And let me tell you, I've looked. This is a tremendously advantageous way to trade. The reason is, if the stock is trading at $10 at the time you take the trade, and you're quite certain this is going to make a bull move, this stock, as I've mentioned, only has to go up literally $0.01. And you get to keep 100% of that credit. So you don't need much of a move. So in a choppy market where you really don't need any kind of major move on the stock, if you buy a call, you got to pay for the price of the option, which in this case, I don't know exactly what a call would cost, but let's say it costs 50 cents. So you've got to get above that $10.50 at expiration, and then it's got to move a significantly amount greater than that in order for you to start banking profit on purely intrinsic value. Let's say all the extrinsic value is waned, implied volatility, there's no time left on the trade. You're simply motoring on this trade on pure intrinsic value. Well, you got to get the price that you paid for the call and trade above it. Here, you only need to trade 1 cent above $10 or even at $10, doesn't have to move at all, and you have yourself a 100% winner. So you can see how in a choppy market, this is an exceedingly advantageous way to trade. And what we're going to do is we're going to look for stocks that have very, very strong upward momentum, but we don't necessarily think are going to make a big move to the upside, or very strong downward momentum, but maybe major support 20 or 30 cents below our entry, and we only need 1 penny. So it's going to fall. It may hit support. It doesn't matter. And we wind up banking 100% on the trade. So I hope that's really clear. Please put your questions in, because at the end of the presentation, I'll answer them all. So I'm going to close this up, and I'm going to go back to the deck. This is not a long presentation. What's long is finding the great trades. And sometimes I have to go through one trade after the other. I mean, I usually have a list I make throughout the week and try to pull the best stocks I can, and then just go into Thinkorswim and look and see what the 50 delta, 25 delta is going to provide us in credit. Now, I do have a credit spread tool that provides us with stocks that are in the strong. Now, this is obviously shot a while back. This is not the way the market is today, because you see everything is in a strong bullish trend. Now we're looking for stock with the highest IV rank. Here it's 40%. The IV rank is 12%. So we know how much we're going to get. We're going to get 40 cents on the width of this trade. Now, this is a $2.50 spread. Here is a $4 width spread. Now, the narrower the spread, the reason I like them narrower, it gives you and me, and I take all the trades that I send out, which makes this, I think, a very, very unique service. If I send a trade out to you, I take the trade myself. Now, what you need to do is determine the amount of risk you're willing to assume on every trade. You saw on the last trade, you had to assume $55 of risk per spread. Now, if you're going to take $500 of risk per trade, now you must do this, or the opportunities you're not going to monetize the opportunities particularly well. I mean, this is really what is going to skyrocket your profit curve. And it's really just the nuts and bolts of trading. And you have to asset allocate so that you have equal risk on every trade. So in the first trade that I just showed you, which was hypothetical, you're taking $55 of risk. If you're going to assume about $500 of risk, you're going to take 10 spreads. Maximum loss on the trade is $550. Maximum win on the trade is $450. That's an imperative. The amount of risk you take is totally up to you and based on your portfolio size, but it's got to be equal weighted across them all. Now, that provides us with a lot more configurability. Now, over the course of time, I've sort of developed credit spread best practices. So we're going to exit the trade on the trigger of any of these three signals. Now, you may think that this may serve to dampen down our profit, but I'm telling you at the end of the day, what it's going to do is it's really going to skyrocket our profit. Now, let's say that we have the potential to make $100 on a trade. If we make $75 of that 100, we're going to exit the trade. Now, if we hit a stop that's equal to the amount of money that we can make, so what I'm going to do with the stop is bring these trades to a one-to-one. They aren't that way when you configure them on the drawing board, but you can put a stop in that's going to take the trade out. If you, on the last trade, when you lost 45 bucks, you're out of the trade. So your risk to reward is one-to-one. And then we're always going to exit, almost always, and these are rules, but they're bendable, but they shouldn't be bent much. We're going to exit 14 days prior to expiration to avoid what's called gamma whip. And gamma whip happens every now and then, and when it does, it's a catastrophe. And I'll just explain it to you. I have a slide for it. Let me find it here. Whoops, I have all these slides in here, and we don't really need them, but gamma whip simply means that as you move into options expiration and all the extrinsic value of the spread has dissipated, just a small change in the price of the underlying stock leads to an enormous change in the value of the spread. So let's say we're a week out from the expiration of the spread, and we're up 90%, and a brokerage throws out a sell order and does a hit piece on the stock that we're looking at. Well, the stock is going to take a major upside hit, and because we're only a week out, they're going to turn a 90% winner into a 100% loser, or it's going to hit our stop probably with slippage. So we don't want that to happen. If we keep the trades more than 2 weeks out, there are multiple ways we can repair the spread so that we can bring it back to us and still potentially make a nice amount of money. We don't want to go 14 days in, because once that happens, we can't band-aid the trade, we can't format a modified trade, and we don't want that to happen. It happened to me 5.5 or 6 years ago on Walt Disney. It was the day of options expiration. I was up like 99.5% because the spread was going to expire worthless, and a boutique service came out with a monster hit on Walt Disney. It took its biggest single day loss in 20 years, and I lost $40,000 on the trade. So I learned these 3 rules the hard way. So we're going to exit 14 days prior to expiration. Now, if I had time on that spread, I would have been able to repair Disney. But because it was the day of options expiration, all I could do, I was in the pharmacy at the time in CVS getting a prescription. All I could do was sit there and, you know, have my knees knocking. There was nothing I could do. We're not going to let that happen. Now, we're always going to look for the best performing sector, which has been energy. And then we're going to look for the best performing subsector within that major sector. And that's been oil, services, and drillers. And then we're going to look for the best stock within these subsectors. And that's one of the ways that we're going to trade. Now, I'll show you a trade that we took, and this wound up giving us a 100. We didn't get a 100% winner. I think we got 70 to 80% of our net credit. I think we got 32 cents out of 40, but we took a bearish position. Remember, we sold the 50 delta call and we bought the 25 delta call. So that's a bearish position. The premium width was $1. The premium percentage was 40%. The IV rank was 36%. So when we sold the spread, we got 40 cents of net credit, looking for CSX to go down. And it really went down. I mean, it was trading around, we wanted to get below 31, which is our key level when we're taking a bearish position. And it really went under 30. But just because we don't want some unforeseen event to change the trajectory of a stock, they announce a big stock buyback, you know, God forbid they get purchased by another company, we're going to wind up with 100% loss. We took it off the table and we took our 32 cents, which was 80% of our potential net credit. It's very, very easy to configure. The tough part is finding the stocks. Now, in order to take a credit spread profitably, as I mentioned, you have to equal weight or equal risk every trade. You take a $1 wide where you risk $60. If you're going to allocate $1,000 of risk to each position, you're going to take 16 spreads. If you have a 15 wide, now I rarely take a 15 wide. I just don't like them because they're a lot harder to manage, and oftentimes they don't give us as much credit as the tighter spreads do. Here we got $6 of credit, we risk 9. You're only going to take 1 spread. So although it may seem like this is going to lose a lot more money, they're really all going to either make or lose about the same. And the profit potential is all based on implied volatility, the IV rank. That is the key. And obviously we need to be able to determine the appropriate direction, but it doesn't have to go very far in our favor, I can tell you that. Now, if we fall below, here's our 40 cents or 45 cents, here's our 55 cents, and it falls below here, we can take no action whatsoever. We just have to bite the bullet. There's nothing that we can do to repair the trade. But if the trade falls below the put we bought or the call we bought, then we can potentially repair the trade. And remember, we can always take assignment of stock on the trade and simply nullify the trade. So there are lots of ways that we can move on these spreads that really provide us with a tremendous advantage. If somebody executes and hands us the stock, we're going to execute and hand somebody else the stock, and we're going to wind up taking a full loser, but we can never lose more than the maximum allowable on the trade. It can never happen. We had one trade on Lockheed Martin that just fell through the floor. There were multiple ways to repair it. I got assignment on Lockheed Martin. I'm still holding it, and I am up a bucket load of money on it. But not everyone can handle that assignment because it's an expensive stock. And even with that happening, we bought a bunch of puts on it, and the stock continued to fall. And we made a lot of money to the downside, even though we took a bullish position. So I sort of went through all the things that you can do. Obviously, here we're going to get a 100% winner. Here we're going to get a partial winner. Here we can really do nothing on the trade. When we're middled on the trade, it's between our lower and between our upper call or put. There's nothing that we can do. But when it falls through, then we can always take action. So if we wind up with a really big loser, and so far we've only had one, which has been Lockheed Martin, and it came on news that was unanticipated. And there was a recall in their jet engines because they had a flaw in their in one of the engines they made for one of their planes. I can't remember what it was anymore. And it just blew the stock right through. And also it announced that instead of delivering 150 F-35 fighters, it was only going to deliver 150 F-35s. It was only going to deliver 85. Now it said it was not going to touch their bottom line. They still predicted a very strong quarter. They wound up beating earnings consensus estimates and flying on that news. But traders trade in a knee-jerk way. So they just blew the stock through the bottom, but we took action that really mitigated our losses. And if you could take assignment and hold it, you wound up making a mint on this trade. And this was the Lockheed trade. We sold the 450 put and we bought 455 put. We bought the 440 put. We got a credit of 560, a risk of 940. You can see that's a big risk. And, a halfway decent net credit, but not a hugely, not the kind of net credit that I want. But I took the trade anyway because I really felt that Lockheed and the defense sector was really going to fire out of the box. Well, Lockheed on this unforeseen news fell through the floor, but we still were able to walk away with money. Now here, as I said, we take no action. Now, we're going to do an educational session, and we're going to do a series of them. And what I'm going to do is I'm going to teach you how to locate optimal trades. I'm going to show you how our scanner works. Now, the thing that we may do is I'm going to show you how you can repair a spread that is not middled, but actually falls through the bottom. Now, if you have a $1 wide spread and the trade goes really against you, there's a lot of things that you can do. One, to minimize your loss, and two, to potentially turn that trade into a winner. And it takes about 2 hours to go through all those things. That's another thing about taking these spreads. When you're 3 weeks to 3.5 weeks out and the spread doesn't go in your direction, there are multiple ways to repair it so you can still wind up with a nice winner. I'm going to give you all the trades. I take every trade that I send out. This is how I know if we got our net credit. Now, I sent out a trade on IMAX on Sunday night. IMAX was a $1 wide spread. They gave us 45 cents of credit, but IMAX gapped up on Monday morning and ran. So at the end of the day, the spread was only worth 30 cents, and I was looking for 45. So I had to dump the trade, and I had to look for another one. And what I did was I moved over to Lyft. And Lyft gave us 45 cents of credit on a $1 wide spread. Whoops, let me just close this. I'm sorry here, let me just unshoot for a second. Went up seeing my son from a few years ago, and let me get. I have what I did was open up the wrong deck. They're pretty much the same, but here we go. Let me just scroll down to the slide. Now, here's one thing that I just want to go back to just sort of emphasize it because it's so important. They should be able to see the slides again. Now, you look upon a credit spread. You know, there are people that I always also get emails, and I get a lot of emails. I still like to see what other people are offering, and they always say never buy options, always sell them, and that nothing could be further from the truth. The way you look at options is exactly the way you would look if you're running an auction. Now, if you're standing at the podium, now if you have your choice of standing at the podium or being in the audience, when would you choose to sell the object that's up for sale, or when would you choose to be in the audience to buy it? So when do you want to be a buyer, sitting in the audience and paying a fee, versus when do you want to be a seller, the auctioneer, and collecting a fee? And the answer is real simple. You want to be a buyer when the cost of the item, and in our case, the option, is low. So if implied volatility is extremely low and the option is cheap, we're going to buy it. If the price of the option is extremely expensive, we want to be the auctioneer and we want to sell it to someone else. And there'll always be somebody else willing to take it off our hands and give us what we ask, as long as the position that we sell is liquid. That's how to determine whether you want to buy options or sell them. To openly declare that you never buy options is nuts. You don't always sell them because you're not going to sell a cheap spread. You're going to buy it. So when implied volatility is low, the cost of the option is almost always low. When implied volatility is high, the cost is high. That's why when you trade before earnings, implied volatility is going to be extremely high and the cost of the option is going to be exceedingly expensive. If you really feel that you have a great handle on the direction that earnings is going to take a trade, it is always better to sell a spread. Although it caps your upside, it also limits your downside, and you don't have the potential of taking a massive loss. And you can trade as many spreads as you want. When the cost of the option is high, you always sell it. I'm just going to move through here. is what I really went through this. I mean, what I look for is a cup and saucer. It's called a frying pan bottom on stocks. This is my favorite pattern. This in consolidation. You know, I'm not a big fan of rising and falling triangles, but I love these kind of trades where they break out above resistance and run. These are very nice trades because once they break this area of resistance, they don't have to run far. And boy, do they move. Here's another one. This is on Antero. We got a 40% return, broke and ran from a frying pan or rounding bottom formation. And this was Caesars Entertainment, which has really since done awful, but it broke out of this frying pan bottom, broke resistance, and man, it moved up. It moved up a couple of dollars. I could have, and like I said, I could have broken my formula, and I could have waited till expiration, but I did not. I took the trade out. Now this is the gamma of the trade as we move into expiration. And you can see that a small change in the price of the underlying stock causes a major change in the value of the spread. And we don't want that to happen. And that happens when there is no extrinsic value left in the option as you're nearing the expiration date. Now, this is really a little bit dated. Right now, we've closed 10 positions. We have 8 winners and we have 2 losers. One of the losers was Lockheed Martin. And we took another loser on Datadog. Our 4 open positions right now are very, very healthy and looking really good. And they were flying today. These are our 4 opens. No, well, I still have Datadog in here, but I don't think that's the open one. Let me go back and take a look. We have Lyft, we have Uber, we have Marathon Oil. Those are all doing really well. And let me look at the 4th one. I don't think it's Datadog. Let me check it. No, it is Datadog. It's still in there. And let me tell you, it is off. It needs a little bit of a move up, but it is doing well. Uber is real strong. We got into Lyft today. Matador is really, really doing well. We just need a little bit of a push on Datadog. I already went through this. So let me, here's the service. You're gonna get 2 trades sent to you every Sunday. Now, what I've been doing is I've been cutting those to 1, simply because the market today, this particular market has been so risky. Remember, I take the trades too. So I'm just not sending these trades out to you this is not an alert service where you're just gonna get a trade and I can wash my hands of it and then walk away. I'm in the trade as well. I don't want to assume more risk than 1 spread right now. If we start to trend a little bit better, then we will go to 2 spreads. Remember, every 6 weeks, we're going to dump 2, and it's going to start to be where every week, 2 leave, 2 leave, 2 leave, so we can bring in 2 and 2 and 2. So we've cashed out 8 as winners. We've cashed out 2 as losers. Remember, the risk to reward should be about equal. So we've cleared 6 nice winners where the amount of money you made is totally up to the amount of risk you took, which should have been equal across each of the positions. Now, in this current market environment, to be trading at an 80% win rate is really remarkably high. I mean, options traders are getting murdered. Now, I follow one of the most I think, respected option services in the United States, at least. And they closed 11 for 11 losers with their last cycle. Not going to mention their names because I never mention names. They're very famous, and you would know about them in a second. You've been trading in the market for more than a month. 11 for 11. They had one big winner on Molina Healthcare, dropped 15 bucks in one day on a 10 wide, and they were finished. That was the end of it. So they closed with 0% wins. Now, I'm going to give you the entry price, the stop, the targets, and we send out a lot. I send out a lot of intra-week alerts. The flagship email goes out Sunday night. I'm usually going to go into a description of the market, but that's when I'm going to try to bring in our best trades. But if I see one occur midweek, or if I see something happen in a trade that we're in, you're going to get an alert. And I've been sending out emails to beat the band. I sent out one today on our regular options, where we're mostly trade calls and puts, and I wanted to get into Raytheon. Now, Raytheon, unfortunately, we just cannot trade on a credit spread because it doesn't have enough implied volatility. So you're going to get multiple intra-week updates. Now, every other week, we're going to do a credit spread training educational session. Well, I'm not going to send it out for marketing. It's for members only. The first one I'm going to do, we'll do a one on credit on spread repair. Because knowing all the options that you have to repair a spread that's fallen through the bottom of our width, there's so many ways that you can manage those. It makes these trades really, really advantageous to take. So I want to make you a master at trading credit spreads. Now, I've been trading options since 1997. And I'm telling you, there are only 3 kinds of options trades that you should take, in my humble opinion. Actually, only 2 kinds. You want to be a naked trader. You want to buy calls and you want to buy puts. I hate buying bull call spreads or bull put spreads because I don't like the fact, although it may be a little cheaper, I don't like the fact that my upside is capped. And on these trades, I'm looking for a huge move up. So if I have to pay $1,100 for the call, I sent one out over the weekend that cost $1,050. I'm going to do it. I checked the optimal credit bull spread. It costs like $9 and change. So for $1.50 more, we have an unlimited upside, and we only have an additional $150 of risk. So I hate trading spreads, and the more complex the spread, the more I dislike it, the more legs. So you want to be what's called a naked trader. You buy calls, you buy puts, and the only kind of spread that I find to be fantastically advantageous are credit spreads, because you don't need any kind of a major move. Time is on your side. The underlying can really pretty much just sit and languish, and you're going to wind up taking a 100% or 75 to 80% of your potential net credit and bank it on the trade. So the first month is only $21 to come along. Now, normally it's 91. So you're risking very little just to see what the service is like. Now you have 30 days to cancel. Just send an email to info@rightlinetrading.com or call our number, and I'll give it to you. You can come aboard as an annual. We get many annuals. It's normally $12.91. But if you come in on a monthly, you can cancel. No harm, no foul. You will not be rebilled. So I've told you our performance. We're running around an 80% win rate I don't expect that to change. Our 4 open positions look extremely healthy. We need a little bit of a bull move on tech to get Datadog up. I believe energy is going to do extremely well for us. Uber is doing terrific, and I think so will Lyft. Now, I'm just going to show you really quickly because I have the time. What time is it? I've got 8 minutes. I'm going to show you really quickly how to take a trade. Now, I have to move this off. I have to put my username and password in. And I'm going to open up Thinkorswim, and I'll answer everybody's questions. Don't worry about it. Okay. This is my live account. I have it formatted so you cannot see my balance. Now here's Lyft, which sort of fell through support here. You have to watch Lyft really carefully because I looked at this trade before I took it, and it really hadn't eclipsed this support level. So if this trade goes sour, we can take it off with a very, very tiny loss, and we'll have to see how it matures. And let's just take a look at. Let me see what I have on my watch list, and I'll put in a trade. Now I don't know what kind of metrics are gonna come, but we'll take a look. One that I really like, only it just moved up too far, was Vertiv Holdings. And this is another one. I'll put it in. Was Acadia Pharmaceuticals. I don't think we're going to get much of a net credit because they've already moved up too strong, coming off that low. But we'll take a look. Let's say that we want to take the trade on this. Now, we can look at the November 17th. It's not quite 42 days, but just to give you an example, we want to take a bullish position. So we're going to look at the delta. I always look at open interest. We want to make sure that this is a liquid position. So we're going to look at the 50 delta, and we're going to sell it. And then we're going to look at the 25 delta, hold the control key down, and we're going to buy it. So on a 21.23, you're going to get 92 cents. Now that's not bad, I have to tell you. It's less than 50%, but that's a pretty decent credit spread. And what we're doing is we're selling the 23 delta, we're selling the 23 put, which is the 50 delta right here. And we're buying the 25 delta. They're off by 1 or 2, it doesn't matter. And here's our net credit. And we could always ask for 95 cents. 95 cents on a $2 wide is really quite a good trade. And this stock is really making a nice move up off of a bottom. So that's how easy it is to trade. When I took this trade, I would probably ask for 95 or 96 cents to try to get in at a pullback, and I would confirm and send, and that would be it. That's all I would need. So they're very, very easy to trade. Those were all on my hit list for Sunday night, and I went with IMAX, and IMAX just took too much, went up too much. Now I have everything that's offered, but I'm just not going to go into the nuance. But you're going to get a lot of education, and I think hopefully a lot of great trades. I'm in them with you, and so I pay close attention to what they're doing. That's what I sit and do every night. So let me just open up the chat window here and look at the questions. Okay. Now for 21 bucks, if you're hesitant to pull the trigger, I'm telling you, you'll be aboard for either a year or a month when you see the trades that go out. Okay. Well, Jeeper said that the direction of a stock is always uncertain. That is not true, Jesper. I mean, I think we can predict with a lot of certainty, obviously not with 100% certainty, the direction of a trade. Nobody can predict with 100% precision, but you can predict fairly well how well, the direction that a stock is going to move. Hey, Tom, the problem with 50 delta or at the money options have the highest gamma, and selling options too far out have too high a vega. Plus today, most spreads collect too little premium worth. Well, Tom, you just saw the one that I just took on a 50-25 that offered 92 cents. That was an instantaneous execution. If you would have taken it at 92, that was the midpoint that Thinkorswim is going to offer you, and they'll execute the midpoint. And 92 on Acadia is, if I calculate the percentage, it's $2. It's up. It's 0.92 divided by 2.00. That's a 46% width. That's a terrific width on that stock. So I kind of disagree with you. And I just showed you a trade I just pulled out from my watch list. And listen, what I'm sending out are trades that consistently have a width of 45% of the vertical length of the spread. So you know that you're getting a good implied volatility. So you just have to be very picky in the stocks you choose. I mean, it really comes down to that. I mean, obviously, you're not going to get the metrics you want willy-nilly, but they're out there. I totally get what you're saying, though. Trading out of the money spreads is a disaster. I mean, I agree with you there. But I think trading 50 delta spreads can be very, very lucrative. Hey, Tom, I was told to look for buying when IV is 30 or lower and sell if it is 35. Listen, that's a good metric. I mean, I kind of like that. 30 to 35 as your cutoff. But you know what really the bottom line is? The easiest thing to do, Tom, is just go into Thinkorswim or whatever your platform is. Actually do what I just did when I took the trade on Acadia. See what you're going to get. The IV rank is important, but it doesn't tell you everything, and I'm sure you know that. Obviously, time to expiration makes a difference, and we're looking at shorter dated spreads. So they're going to pay you a little bit more money. So that's a little bit of a cheat because these are 30 days out and not 42 days out. But I think that's just a better way of doing it. Go in, take the trade, see what your midpoint is, and then that's how you're going to decide whether you're going to dump the trade or whether you're going to take it. And the trade I took on IMAX, if we just got a little pullback, we would have gotten in great. It just gapped up and ran. Hey, Mark, when does the email come from you? It comes from Right Line Trading. Okay, if you haven't gotten any, Mark, I'll bring that to Rory's attention or somebody at Right Line's attention. You should be getting them. I've sent out, I don't know when you joined, but I've sent out many, many, many emails. We'll bring you up to date. I apologize for that. Okay, and and I'll ask them to extend your subscription by a month if you've not been getting the emails. Debit spreads benefit from the premium you collect, offsets your theta loss, so you don't have to gamma scalp. Well, listen, I'm not trying to gamma scalp, Tom, because I'm taking 6-week out spreads. And what I'm trying to do is stay away from gamma whip. So I totally agree with you. I sort of have the opposite mindset. I don't want to use gamma as a scalp. I want to avoid a major gamma problem by taking them 6 weeks out. And listen, I mean, you can sell a credit spread that's a week out, and then you're going to get hammered with what you said, with a gamma that's way too high. So that's why we set that time frame. And you're going to see the trades are very, very nicely configured, or I'm not taking them. So if they don't go out, I'm looking for a 40 to 45% width on our trades. Now, if you can get that on a credit spread that's 30 to 45 days out, you're doing extremely well. Okay, David, I'm sorry about that too. I'm going to have to bring that to Rory's attention. Okay, we'll make sure you get them. I don't know why you haven't. I'm sorry. Yet, listen, Tom, you always risk assignment when you sell, but you can always then exercise the other end. That's all. So agreed that you risk assignment, but that's the first webinar we're going to do. How do you manage a trade if you get assigned the stock? I don't want anyone to panic because you obviously know your stuff really well. So you know that if you're assigned on one leg, you can just call your broker. If you don't know how to do it electronically on Thinkorswim, you just demand assignment on the other side. They cancel each other out. You have no stock, and you're out with the max loss on the trade. So assignment isn't the end of the world if you asset allocate equally across every position. And you don't panic because you don't have to take assignment right away. Take assignment at your leisure. I mean, if the assignment throws you into a margin call, you got 72 hours to cover, and you're going to cover it, at the price of the spread, at the price of the put we bought or the call we bought. They're gonna nullify. You're out with a max loss. So it's really not nervous breakdown time, pulling your hair out time. It's just simply a time to take action. That's all. Okay, Mark, I appreciate. Now I'm going to make sure that, I hope if Rory's not listening, I'm going to bring your name to his attention. You, Mark, and David, I'll make sure that you get them. And like I said, I'll extend you out a month so that to make up for the lost emails. And I really apologize for that. So listen, everyone, I really appreciate you giving me your time. Like I said, I take all these trades, Tom, for $21. You can see how I configure them. I'm going to give you on the trade the width, the IV rank, the maximum loss, the maximum gain. All the metrics of the trade are going to be sitting right above the trade, and my rationale for taking the trade is going to be there as well. So it's not just going to be like I'm going to throw you a black box trade and you're not going to know why I've decided to take it. I took it on IMAX because they beat their earnings consensus estimates a couple of days ago. The stock didn't move, but I figured it was gonna. And I'm telling you, Sunday night when we set the trade on Monday, it bounced about 4.5 to 5% up. So we didn't get in. So listen, everyone, again, I really appreciate you giving me your time. And I look forward to seeing you in the next educational session. It'll be open chat. Everyone will get to see everyone's questions. And, we're going to do a credit repair session. So everyone have a really wonderful evening and really best of luck. Take care, everyone, and have a great night. Bye-bye.